My name is Rosie Valencia. We'll get started here to keep us all on track on the time. I run head of national accounts at District Capital. We were founded in 2008 as a firm to partner with very unique, experienced asset managers that have very specialized investment strategies and make them available to the retail client. Some of the products that we offer are some closed-end funds, interval funds, traditional mutual funds, and then separate accounts. And some of the managers you've heard from today that we partner with are Ares. We will hear from RBC Blue Bay later, Flaherty and Crumrine, and then Aeromark Financial, just to name a few. For more than 15 years, we've been able to, help thousands of advisors try to challenge the unconventional and conventional market and explore new ways to provide solutions and financial freedom for their clients. I'm joined today with a panel that we are the interval fund track. And so we've talked a lot about traditional closed-end funds. We're going to focus a little bit more on the newer structure. Well, not so new since it was late 90s, but one that has definitely expanded and grown over the last several years. As year to date, there's almost 117 current interval funds, and there's about 54 that are in registration. A lot of those are dominated by credit and multi-asset strategies. And so today I'm going to introduce our speakers. Corey Johnson is co-founder and CEO of Pender Capital. He brings over 20 years of experience in real estate acquisition, development finance, and asset management. He co-founded Pender Capital in 2015 and is responsible for the firm's strategic vision and financial success. The firm is a registered investment advisor specialized in the US-based real estate credit opportunities. And then we are also joined by Aaron Rosen, who is from AOG. He's Chief Investment Officer and Portfolio Manager for the AOG Institutional Fund. He also has over 20 years of financial industry experience and an extensive range of investment management services. He specializes in private investments and also other illiquid securities. And last but not finally least, Michael McGrath with Blue Rock. He's an executive vice president at Blue Rock Capital Markets and head of product for the organization, where he's also responsible for developing and structuring new investment products and strategies and launching strategic initiatives for the financial intermediary network. His process drives product innovation, brand awareness, and product education across the distribution networks. So to get started, why don't I go ahead and give you guys all an opportunity to talk about your unique investment products. We're talking about obviously alternative investment assets being more accessible and available to retail and in a very unique structure. So I will hand it over to Corey first to kick us off.
Great, thank you. Yeah, Pender Capital, we are a credit manager specializing in short-term senior secured commercial real estate debt positions, primarily focused on the lower middle market, which we find to be a rather inefficient and fragmented segment of the real estate debt market. Geographically focus on top 75 MSAs, although we somewhat preclude, the top 4 or 5 because we find those markets to be a bit more efficient, leading to competition, higher leverage points, looser covenants, et cetera, et cetera. We ran a Reg D offering from 2015 up until about a year and a half ago when we looked at kind of the opportunity set that we could obtain within the interval fund space, deliver a product to our clients, which are primarily registered investment advisors, to be a little bit more operationally efficient, removing accreditation standards, 1099, still getting qualified retaxation, making it more palatable for those operation teams to facilitate investment into this type of vehicle. Really looking at kind of what we do in the debt markets, we almost exclusively, everything 100% senior secured. We like to be the first to get paid. We like to be the last to take a loss. We run our interval fund as a single strategy, which is a bit different than I think some of our competitors. We focus exclusively on the origination, underwriting, and asset management of these loans that we are providing ourselves, do not have any sub-advisors. And really at our core, our strategy is one of those that, we think of ourselves as principal preservation first, yield generation second. Over a 10-year history, I've never had a negative month, and it's really more of like bunt singles around the basis. That's what we're trying to provide, lower volatility across the board, making it a little simpler and not really having those big ups and downs.
Okay.
Hi all. So Aaron Rosen, run the AOG Institutional Fund. We are, in essence, have designed a core alternative solution. So we don't have a specific focus in any one particular sub-arena of alternatives. We kind of span the entire gamut. The fund was originally created really as a solution by an RAA, a solution for their clients who had alternative exposure and wanted to have kind of a better way to do it. And the fund has kind of grown and become something larger from there. The goal is generally to bring institutional investment access and opportunity to non-institutional investors, in a sense. And that's kind of one of the big advantages of that interval fund structure. But we're a combination of other funds, co-investments, and direct investments span across real estate, debt and credit, PE, VC, managed futures. Really, if you can throw a rock at it and it's uncorrelated to stocks and bonds, we can potentially pay attention to it. So we have kind of well-diversified portfolio within that, a total return mandate, but we tend to generate kind of mid-single digits income generation just from the yield-oriented part of the portfolio. In essence, it's really trying to bridge that gap. I think there's a huge gap in the marketplace, and there always has been, between the type of investment opportunity access that exists for large, high-end institutions and ultra high net worth family offices, and kind of a more retail accredited RAA type environment. And the whole goal of this fund is to really bring those things together, find that access can be, I don't know if I would say democratized, but brought to pass so that you don't need to be able to write an 8 or 9 figure check and have 20 years experience of a network to bring that together.
Great. So I'm Mike McGrath, again, I'm the head of products at Blue Rock. Blue Rock Asset Management is a 20-year-old firm. Their DNA is in real estate. We do 4 things now. So we have a 1031 exchange business, and if anybody ever saw the Fans Exchange Fund, it turns out you can do that for real estate. We've been doing that for a long time, and we're pretty successful in that market. We have a few listed REITs, one that trades on the exchange. We have a private REIT as well. And then 12 years ago, we started a Blue Rock Total Income Plus Fund, which was one of the first funds in the interval space that accessed, true institutionally placed primary funds as well as REITs. So we're fairly early in the space. My DNA, I go back. I was a closed-end fund analyst, which for I guess now it's Steeple. Back then it was Grunthal & Company. So we used to look at closed-end funds back in the day, and it was always the same story about gaining access to, the right structure that helps you invest in an asset class that the individual investors rarely had access to. I was the global head of alternatives at Morgan Stanley. 15 years later, same story. How do we get institutional assets in the hands of individual investors so that they can create risk-return profiles for their clients, similar to what CalPERS or any other large institution can do? And we're having the same conversations today. So the story remains the same. What's been different, in my opinion, has been kind of the structures, and we'll talk a little bit more about that. Yeah.
No, that's great. That's a good
31
segue.
years in the business versus these rookies with 20 years each. So, okay.
So along those lines, as we talk about the interval fund structure, which all 3 of you have, what do you think is the differentiating liner of the assets that you have access to in investments versus, to your point, retail clients that makes your strategy compelling?
So there is a significant difference. And so if you look at and kind of walk through the makeup of our fund and what's inside it, there's very little access to what we could kind of generically consider retailer accredited type product, fund, and opportunity. It's a very small part of the portfolio. It's generally only in there due to a particular need, whether that's interim exposure while waiting for capital calls from an institutional iteration, or a unique relationship where we've directly negotiated unique terms or relationship with that group, whether that be no-fee co-investment rights alongside, that type of thing. So on the names that you do recognize, there's usually a very specific reason, and there's generally some advantage through fee breaks, terms, co-invest, et cetera, to add significant value from our end. We're very hard pressed to put any of those type of funds in unless there's a very significant value add that we can bring to the table. For the most part, the fund is made up of generally like true institutional product and opportunity. And whether that is co-investments alongside other managers, direct opportunities that have come to us, debt or equity side, or kind of high-end institutional funds. A lot of the funds that we invest in have $5, $10+ million minimum commitment sizes. A lot of them don't actively market at all. What happens is they tend to, this is kind of one of the realities of this world, some of these groups that are the most consistent, invest in what they do, they don't need to go out and actively raise capital for years on end. They'll run vintages every couple of years, and there's a line of the pensions and endowments and family offices that just want into the next one. They'll open for 3, 4, 5 months, whatever the case may be, raise the capital because it comes into them relatively, kind of proactively, right? And then shut it down. So a lot of times there's a huge minimum and or a need to have that relationship with them to be able to access it and get a hold of that opportunity. There's a number of things in the portfolio like that. There's even investment where we're the smallest LP at a 10 million commitment. We're smallest by a factor of 4. So you can imagine obviously the kind of typical size of the other LP investors alongside.
And I think one thing we found was, over the years of, really kind of, working around the RIA markets, we were finding that the RIAs, unless they had a very robust research and operation team, they were doing all this work for maybe a handful of their clients. If they didn't have exclusively the ultra high net worth clients that were, were more suitable for the private markets. So we really kind of were looking at it, kind of coming up with, is there a better, mousetrap for them to get into? We're doing the same business, same term and liquidity. And I think that's one issue that fit our particular vehicle very well, because most of the credits that we make are 1 to 3 year in term, a lot of roll off that happens, on a quarterly basis. And we did run an evergreen before that had a quarterly liquidity. So getting into the interval fund structure was a little easier for us. But I think what it ultimately did to our end clients, it now allowed that group, hey, if we're going to do all this background and research, we can actually open this up to a larger swath of our clients coming through. So kind of created some value add for them there. And then obviously from the operational side of the table, for those groups that didn't have the, the robust metrics of how do you track down subdocs, are you tracking down K1s, no one likes that, it really made it operationally more efficient. So it was really on our end, I think more of a structural change that allowed more clients to kind of get in and experience the type of return profile that was maybe precluded to them from in the private market setting.
Yeah, and I'll say, ticket size, liquidity, and due diligence, right? From a ticket size standpoint, you just walk through it, right? You want to get as many people to have access to the product. The concept of an evergreen fund versus vintages has always been a challenge for the bigger platforms, because when you think about, again, I call out Morgan Stanley a lot on this, but we would take 1,500 meetings and we would do about 100 new things a year. So even if every product was an A number one, we wanted to do it, our selection rate was still super, super small. So we would really be looking for evergreen product. And I think the interval fund has been able to solve for that. Now, it doesn't solve for it perfectly, because I think there's some challenges. And it seems to me, again, being an older guy, the structure gets challenged every 10 to 15 years, right? Originally, it was challenged with the senior loan prime rate funds, where they get stable NAVs. They're giving you a couple 100 basis points of yield premium. They're liquid on their depending on their structure. And then the hedge funds came in and they were like, how can you market this thing at par when I can buy it at 85? Huge disruption to the market, right? Then fast forward to when the endowment funds started using the interval fund structure, the tender offer structure, where it was like, all right, we're going to balance a 70-30 or a 60-40 liquid and illiquid. And then there was a run on all of the funds, and next thing you know, your 70-40 liquid versus illiquid was 70-30 illiquid versus liquid, and the lawsuits came on, right? I see a little bit of that now, right? I see people talking about the stability of NAV in private credit. History doesn't repeat, but it rhymes, Mark Twain. That's the argument they used to make about senior loans, right? In the 90s. And you could Google the lawsuits on that. And it wasn't about people, there were kind of two different parts of that conversation. One was people were paying management fees on inflated assets because they weren't marking the portfolio to market. And then the other was new people were piling in every month because they thought the NAV was stable, but they were paying up for something that other people were paying 85 for. I think the market has to settle a little bit of that. There's one fund right now that's growing really, really quickly. And I think that's typically when you start to realize that, there's going to be a lot of eyes on the structure. Like I said, the 40 Act has been incredibly malleable over the last 30 years, and you're allowed to do a lot more in it. But, the main thing, the way I see it is, these evergreen products, you want to do due diligence on something. You only want to do it once, and you want the product to be around for a long time so that people can see it, do their own due diligence late season, see how it performs in a full cycle.
So you touched on one of the next questions as well, but I'll make the comment too that we know that the 10 largest interval funds probably have about half the assets currently in that structure. But along those lines, as risk, right, we give access to the retail client to these unique institutional-like strategies. What do you think the average investor, having this access, what are the risks for them?
Well, I think first and foremost, it's understanding the client, and this is a more liquid option, but it is not a liquid option. And I think the advisors have to do a very good job of educating the clients and understanding the risk associated with putting a client into something that only has quarterly liquidity that you may not have full liquidity, depending on kind of where market cycles go. I think you brought up an interesting point with kind of where the massive amount of inflows have gone, though. I mean, you look at it, they've gone to, 10 very large players, a lot of which on the corporate side of the table, which I think is rather interesting. We've looked at kind of our space, more generally speaking, and because we play in, it's a nichier segment of the market, but it's a large niche that you just have not seen, there's been so much flow into credit, but in kind of the real estate debt space, more specifically on the interval side of the table, you really haven't seen those amount of inflows. And, real estate by and large has, been through the ringer a bit over the last couple of years. We haven't seen kind of the corporate side of the table have that same dislocation just yet. And what Mike was kind of alluding to, everything sounds great until it doesn't. But, one thing I think it's interesting. What we're looking at too is because, again, we don't have any sub-advisors that have different leverage or liquidity requirements down beneath us. We've just got a kind of portfolio that kind of kicks along. And I think it's a little bit easier from the transparency segment to really understand kind of what's in these loans, what they are. And, for us on the real estate side of the table, it's been kind of a heyday with the regional bank dislocation that's happened alongside of us. So giving us a lot of origination opportunities and really resetting our first dollar of at-risk basis, like that risk level down so significantly. Now we have new valuations that have come in. The market's just a different place. We're lower leverage attachment points, higher yields, higher covenants, which you kind of, when you drift upstream into the more institutional space, which is much more efficient, you see more competition there. You see those covenants get a little looser as people are trying to, get out these large swaths of capital that they have within them. So it is a little bit, differentiating segments of the market, but I think that's one of the risk factors that every advisor has to look at when putting a client into any one of these vehicles.
Yeah, those are good points. And I agree, and I want to kind of take it a little further on something you said. Interval funds, first, they're a structure. So a lot of times there's a confusion. Someone will say, oh, I'm not a fan of interval funds, or I'm a fan of interval funds. And it's a lot like saying I'm a fan or not a fan of mutual funds. I mean, it's just a structural wrapper. What really matters is the fund, the product, the investments that are in whatever it is that you're potentially considering investing in. You have to know that. So just going and saying, oh, okay, I want to add an interval fund, I think it's in a lot of senses an injustice compared to finding and identifying the interval funds that are providing a value add, an alpha generation over what you could do in a liquid investment. Because in the end, interval funds are not liquid investments, right? You can call them semi-liquid, you can call them illiquid, but the reality is the one thing they're not is purely liquid in that sense, right? So the reality is to have some level of illiquidity, you should really be inherently getting rewarded with something that you can't duplicate or do otherwise in a public forum or a public environment or a public investment. So I always think it's really important to understand the funds that you're looking at, what it is they do, how they do it, and how it is more efficiently done in something like an interval fund structure than in something else. That's the big thing. I would say, one other thing you talked about or you brought up was the largest groups. When we're looking at other managers and to kind of invest alongside and potentially even invest in, early on you worry about style drift, but later on you start to worry about alpha becoming beta. And so in the sense that at a certain size and extent, a portfolio inherently starts to lose some of the sharpness of its teeth in being able to generate significant alpha. And it does dilute a bit of that return stream down into more of a beta exposure to a particular area. And so I always think, especially when there's a lot of flows coming in very quickly at significant levels and they have to put that to work quickly to avoid a cash drag, it's one of those things to be aware of. So as some of these funds become extremely large, I think it's really important to look at how they're allocating their capital. Does it match up with the way they were before? Does the return stream of that align? Or are they slowly becoming some generic exposure where you may be better left looking at someone who can be more adept or quick?
Yeah, from my view, I think about it again. It all comes back to education and due diligence. This is a structure that's being introduced to a lot of individual investors that haven't seen these types of assets before. And in the old days, right, when it was an access play, if CalPERS was allocating to the next big thing, and the market turned, well, they would hedge their exposure, they would put in their redemption requests, and they would just move on, right? There wasn't really a huge post-mortem. But when you introduce the same exact products into kind of the wealth world, it's going to what did you know and when did you know it about how did this fund go south? And did our investors understand all of the risks? Did the due diligence file try and identify the risks that were going to be key to the investor experience, right? And I believe that whole process is really where a lot of the risk is. I mean, listen, investments are going to go up and they're going to go down. Some of them are going to go up more than others. But if you're in equities, there's going to be volatility. There's going to be volatility in anything that's going to give you some type of a premium return. So clients, I think at the end of the day, know that. It's just a matter of is the product or the investment performing as expected? We all hope it does better, but is it performing as expected? And if it does, there's not going to be any problems. But if it doesn't, then the postmortem is going to be where people are really going to be spending their time. And that always leads to more regulation, and that makes it harder for all of us to deliver these products to the clients.
So we talked about the uniqueness, obviously, of more niche strategies that you guys manage. Why don't we, address or talk about anything that you guys are doing within the portfolios currently from a sector allocation or specialty, with the current market environment for the next 6 to 12 months? How are you guys positioning the portfolios and for our clients?
Yeah, I can jump in first on that. So, we're a little different than these guys in that we are multi-asset class across alternatives. So one of the first things there is that we can diverge and over and underweight significantly to a particular arena. And so if you look at over the last, let's say 18 months, 18 months ago, our fund was almost 50% real estate equity. We made a very conscious decision to dramatically cut that out about 18 months ago, and within 12 months, we dropped that to 6% of the total fund. First off, that's extraordinarily hard to do, end of sentence, but let alone if you have an array of clients and paperwork and approvals and all that sort of thing. So part of having the fund structure allows us to be able to move quickly and consciously, but also to have confidence in the move, right? If we decide to do something like that, we're gonna do it. So there's been, historically speaking, some significant moves. We tended to build up private credit and debt and some secondary PE exposure over that period of time with those dollars that were coming in as we put them to work anew. What we're looking at today and kind of, you said the next 6 months, if I think about it that way, what we've really started to do is kind of rebuilding that real estate side, right? We didn't want it, we have no intention of staying at 6% real estate. We're actually already back up to 15. We'll continue to grow it out, but we did it in a very different way, right? So we removed out kind of existing or late vintage real estate equity portfolios where we just weren't comfortable with those scenarios for each one. And again, this was underwritten to each individual portfolio. So I'm making a generic comment, but it was specific to each. And instead, the way we're rebuilding it now first is on the debt side. So real estate debt, and I'm sure is music to Corey's ears too, and he'll vouch for this. Real estate debt recently and still today has been very attractive. And if you look at the LTVs that you can target at and the yield generation and returns that you can get with a lot more security, we're hard pressed to look at the equity side and say there's a better risk return or risk reward potential there, right? It's very asymmetric compared to the equity side, at least today. So when we think about rebuilding that, one of the ways we have been doing it is debt. And the other way is kind of very unique niche arenas on the equity side. So instead of getting broad-based exposure, we'll target a particular area. So for instance, cell tower development. And then we'll talk to one of the, we have an investment in there, it's one of the premier cell tower developers in the world. When we invest in them, they have a very, very unique proposition in what they do and access and network. And that makes sense to us, right? There's a particular thesis there that makes sense to us long-term from a supply-demand imbalance story. The need to have that kind of last mile, if you will, for data, bringing data to end users, right? Having a place to do that, right? The way to do that is a perpetual need. And we are just getting more and more digital. I'm sure everyone is aware of that. But having that and having it in an area that can't quickly be, technology can't quickly replace, right? If you think about versus say a data center, where data centers are attractive on standalone, but they tend to have very low, like their life cycle is shorter. And technological moves can dramatically shorten that in particular scenarios. Versus a cell tower. Cell tower exists and you can really just continue to be more efficient and sell off more of the real estate of the cell tower itself. So it's those type of things that we're really thinking about as we build that back up.
I mean, it's an interval fund, right? So, ours is a $5 billion interval fund, so it's kind of like a container ship. There's not a lot you can do unless you're fortunate, you're getting a lot of money in on a quarterly basis to really significantly kind of turn your investments. We do have a liquidity bucket where we could go and use REITs, but I would call, because ours is 12 years old, right? It's a full cycle fund, right? What does that mean? Set down years, right? You don't talk about full cycle unless you've had some losses in the portfolio, and that's what's happening right now, right? There was a readjustment to real estate, so there have been some opportunities to change. But we think that the portfolio that we have on the table is the one that's going to take us through this next cycle. So there's been changes around the margin, but not really. If anything, we, as a firm, we got very lucky. We had a listed multifamily REIT that got taken out by Blackstone 2.5 years ago at a 40% premium over its market price, right? So, we can talk about our ability to do well in all markets, but on the interval fund side, it's not necessarily a message that we're trying to send that there's a lot of agility, because if it is, well, then maybe it's not the right structure, right? If you turn over the portfolio in a year, then maybe it's not the right structure. I'm just kidding. We're investing in primary funds, they're locked up. So unless the money is pouring in, there's not really too much you can do. So you have to know that the portfolio you built is the one you want to be in and suffer through the tough times.
And I think on our end, obviously we're a little bit more boring down the middle because we do one thing. We're really just adjusting kind of what type of assets that we're lending against. You look kind of, what happened during COVID. You had, the barbell kind of recovery on, industrial, multifamily did very well, retail, office, hospitality, healthcare kind of went in the toilet. So, we're always adjusting kind of where we feel we can get the best risk-adjusted return. Multifamily is an area that we continue to be a bit overweight in, roughly about 60% of the portfolio. A lot of that's due to the takeout financing available. That's one thing that we're always looking at is who's going to take out, our short-term bridge loan with more permanent financing. Fannie, Freddie, and HUD have been active there. We're seeing some signs of life. We've seen the bid-ask come in on some of the non-favored asset classes that we've been a little bit more active in. We feel like, at our basis, there's some really interesting opportunities that are kind of presenting themselves there. And, as much as I kind of like some of the regional bank dislocation on the origination side of the table, because it takes some of our competitors out of the play, we would like to see a bit more liquidity come back into those folds because they are a large provider of that takeout financing from some of those non-favored asset classes as well. So a little bit of, we're always kind of finger on the pulse of kind of where we think we're going to get the best risk-adjusted return, but we do not have the same other drivers as Mike and Aaron do up here.
Great. I do want to ask if there's any questions out there as well, as we're getting close to the end of our time. I have maybe one or two more here, but opening up to the audience. Any questions? Go ahead.
Do you see more back or opportunities when Blackstone started blocking the exits? Can you touch on any good war stories around that time?
Well, I'll tell you, we were going through our conversion when BREIT was gating and FTX was blowing up. That was a very interesting time, and this is a true story. We're at our final SEC review meeting, and they've got 16 people. They're all on a Zoom call, and the gentleman leading for the audit team, he had a Captain America Marvel shield mounted to his wall. And I remember looking at that. I'm texting our lead attorney. I'm like, this is going nowhere today. We're up against Captain frickin' America. It was definitely, I think real estate had a bad taste in the mouth with the SEC during that period of time. I think people have slowly started to understand, this goes back to what Mike was saying earlier, understand what the clients are going into. Again, this is not a liquid option. It sounds great and on its surface, but you really have to understand what you're putting the clients into. So that's my early story.
Yeah, I don't think I have any as good as the Marvel shield. But I'll say this, right? When the portfolio was first started in kind of the first 12 months or its infancy, the portfolio had added in some kind of what we'll call more of those generic accredited, other interval funds and REITs and that sort of thing were in there that have subsequently been replaced. But as we moved out of that, it wasn't just about the structure. Like I said, it was the underlying assets. But BREIT was actually one of the holdings in the portfolio. I think it was one of the larger ones when I joined in, and when we looked at it, what I'd say is there was an inkling that something like that might occur. Just having a real conscious understanding of what was going on, how things were going to get marked, being aware of the headlines that were coming out and what the effects would be. And so we were ahead of that. I will say that with that and several others, as they've locked up, if we had been stuck in those and we'd had to deal with that and the substantial pro ratas, it would have completely changed not only just our fund makeup, but our ability to put capital to work in a better way. Might have killed the fund before it could really even get running. So it was something we're very conscious of. So it's more is an internal type thing that we look at and say, yeah, avoid that type of scenario, try to be aware, try to be ahead of it. I think the other thing is it brought to light, at least for some conversations we've had, it's brought up this now, I'd say what is much more consistent question, which is, well, what if there's a run on you, right? What's going to happen, right? How do you have liquidity, et cetera, et cetera? And setting aside the moment that, we tier out all of our liquidity, it allowed us to kind of make a point, and this is specific to us, but one of the things that tends to happen, that can cause this is when you have a particular sector arena that you're in, and you see widespread decline in value there, and you see at least some period of kind of adjustment downwards in price, that tends to push redemptions, right? And then it becomes a self-fulfilling prophecy. Redemptions get to a pro rata or a Q, then people see that, and then they want to run for the hills. Then those managers have to sell more assets to meet those every quarter, and which declines the value further, and it creates this storm, right? At least for us, being multi-asset class really helps us avoid some of the extremity of that risk, because if something has a particular effect on just real estate or in the private credit market, or let alone a subset of it, on the PE side, if multiples are down and the IPO market's not as hot, right? We have other investments that will kind of counteract some of that effect, and it will only be part of the portfolio anyway. So you won't see the same type of extremity in kind of interim movement, and that diversification within the portfolio itself helps us kind of mitigate some of the risk of having that type of scenario occur. And so I think it's brought a little bit of light to one of the maybe less spoken advantages that at least we have.
And these guys pretty much covered it. I would say that the drama wasn't necessarily the gate. Because again, going back to the education, if you were surprised that you were gated, then somebody did not educate you on what you were buying, or you didn't educate yourself on what you were buying. I think the longer term story is going to be in the marks. And I think that's where the good war story is going to happen, and I'm not sure that chapter's been written yet.
Wink, wink.
Other questions?
So one quick question, maybe this is for Mike. So you talked about, and I think you were referring to private credit,
I was talking about nobody in particular
don't want to directly think about the space. And there is quite a bit of interest on the part of the client going into that space. And I'm curious, just given the interest, given the idea around computational alternatives and the focus on but how do you really avoid that particular concern around the, you obviously do the right thing, do the necessary diligence on the opportunity. Advisors are excited about the potential in that space. How do you propose one limits that potential explosion?
Yeah.
I think that's the point.
No, you're spot on. I've struggled with this my whole career, right? When you look at the way these portfolios are sold, one of the things that they use as a selling point is the stability of NAV, right? That's a myth. That is an absolute myth. Unless somebody buys it on day one and they hold it until every loan in the portfolio matures, everybody's experience is going to be different from an NAV volatility standpoint. And when the markets are reasonably stable and assets are pouring in, then yeah, the NAVs are stable and they might even climb incrementally over time. But that's, I think that's the biggest risk to it, right? So again, it goes back to due diligence, understanding what you're buying, but it goes more back to education and truly making sure that the individual investors, the home offices, I ran diligence at Morgan for 7 years, right? We focus, and they focus still today, on making sure that the education is one of the premium parts of the client experience. And we do that at Blue Rock, right? We have a whole department that talks about educating the financial advisors. Because if you really think about it, right, you have a direct investor, right? And then the direct investor is going to go to their IR marketing people, whoever that is, right? And then that IR marketing person is going to go to the home office of Morgan Stanley or Cetera or whoever, and they're going to tell that story again. And then that person is going to bring it to the due diligence team. And then that due diligence team is going to bring it to the financial advisor. And then the financial advisor has to bring it to the client, right? That's a long way from, an institutional investor doing what they do best to the end investor hearing the story. And, there's a little bit of sales in there. So, I think it goes back to education.
Yeah, I might add to that too. One thing I think you've heard all of us mention to some degree, and it really can't be mentioned enough, is how well you have to understand who and what you're investing in. And so when we look at it, when you have generic exposure, right, groups that are not really originators, that are buying off kind of generic debt, we will avoid those like the plague, because the reality is they don't have a lot of control over from the private credit side, right? They don't have a lot of control over it. They're just picking up that same beta exposure, and so you're going to get the tide's going to move you up and the tide's going to move you down, and you're really just going to have to go with it. Versus identifying managers that have a true expertise in their arena and being perfectly content with having kind of niches and subcategories and then just diversifying amongst those type of managers. And then when you can identify something that someone does well or better than most, that's where you align your dollars, right? So we really try to target finding true competitive advantages, true niches. Everyone will tell you they have them, very few actually do. This is just the simple reality of things. But when you identify, there's usually some asymmetry there in that return potential. You identify that and you just try to have a good understanding of what it is and have confidence that manager can weather the storm. Or if it's a direct investment or co-investment, the same thing, that you know how to deal with this in a worst case scenario so you can come out ahead in the end.
I think you guys pretty well answered that.
Yeah, and we're due on time here, so I'll wrap it up. I do know, I think, asset allocation is key, as we know, that, and making sure that they're positioned. You can't time the market, and I think, to your point, education is the key, right, to educating your clients on these interval funds and how they play in the portfolio allocation. All right, thank you.
Yep.